Let us move to the classification of cash flows activities as stated in para 6 of ASB 107. There are three main activities, three main classification. The first one is operating activities. These are activities closely related to the principal revenue producing activities. For example, retailing or providing services to your customer. And this is other activities that are not investing or financing, other than financing or investing activity. So what is investing activities? The acquisition of long-term. This is a long-term, not talking about stock. Yeah, this is a long-term or non-current assets. Non-current asset and other investment not included in the cash equivalents. So these are called as investing. Yeah, if you put the money to fixed deposit, that is not investing. That is considered as cash equivalents. Yeah, because it's very easy to convert to cash, and you know the amount of cash you're going to receive. Financing activities are activities that result in changes in the size and composition of the contributed equity and also the borrowing of liability. You still remember we have assets is equal to liability plus equity. If you increase your equity by issuing new share, your cash will certainly increase. If you increase your borrowing, long-term borrowing, your cash will increase. If you do a share buybacks, so your equity will reduce, your cash will reduce. Same things with your payment. If you redeem your debentures, you need to pay a certain amount of money, so your liability will increase. This is more on the financing part, the equity and borrowing of the entity. So classification for interest and dividend received and paid. Though the ASB 107 does not prescribe how interest and dividend received and paid should be classified, but para 31 requires cash flow from interest and dividend received and paid to be disclosed separately and classified in consistent manner for the period of operating, investing, or financing. So this paragraph requires you to have a separate disclosure for the cash received from interest and dividend. So we must make clearly the amount of interest received, interest paid, dividend received, and dividend paid. Para 33 explained that interest paid and interest dividend received are usually classified as operating cash flow for a financial institution, but there is no consensus on the classification of this cash flow for other entities. Okay, for financial institution, for example, bank, yeah, or insurance company, maybe, yeah, the interest received, dividend received will be classified as operating cash flow. But for other entity, it's not mentioned. Yeah. Para 35 requires that income tax to be separately disclosed in the statement of cash flow and classified as cash flow from operating activities unless it can be specifically identified with financing or operating. So based on para 35, income tax expense fall under operating activities. Okay. Para 36, although the tax expense can often be readily identified in investing or financing activities, the associated cash payment may arise in different periods, making it very difficult and often impracticable to classify tax as investing or financing. This is the reason why we have to classify tax on income under operating activities. Okay, so I'm going to show you two formats of the statement of cash flow, the direct as well as indirect formats. Okay, so We have two methods. Para 8 of ASB 107, IAS 7 provide that cash flow from operating activity may be reported using either one or two methods. If you go to the companies listed at the Dubai stock market, you'll see some of them might use direct method, some of them might use indirect method to report cash flows. But I can see most of them use indirect method, maybe, depends on the country, whereby indirect method, whereby major classes of gross receipt and gross cash payment are disclosed. This is under direct method. Whereas for indirect method, we use the profit and loss, and then we're going to adjust the effect of non-cash transactions, okay, deferral or accruals, okay, and then this item will help you to determine your operating cash flow later on, and also we're going to see what are the income and expense relating to investing and financing cash flow. So for your final, we're going to do indirect methods. Okay. Para 21 requires separate reporting for major classes of gross cash receipt and gross cash payment arising from investing and financing, except for certain cash flow that may be reported on net basis. So we need to have disclosure or classifications for major classes of gross cash and receipt. What it means is the big component, the significant component. For example, if an entity borrow money to repay another long-term loan, it must report the gross finance cash inflow for the money borrowed and also the gross financing cash outflow for the repayment of loan. You borrow money from a different institution. You have, this is your company. You borrow 100,000. This is you. You borrow this one from A, and then you use it to pay B. So because this amount is big, so you need to report in your cash flow statement. This is from your borrowing. This is your repayment. Maybe 100,000. Maybe you pay. Okay. Para 22 of the ASB 107 allows the following cash flow to be reported on net basis. Net basis means the outflow and outflow. You offset, you offset your outflow minus your inflow. That is what we call as net basis. Okay. Cash receipt and cash payment on behalf of customer, when cash flow reflect the activities of the customer rather than those of the entity. And cash receipt and payment for item in which the turnover is quick and the amount are large and the maturities are short. So these are the situation given to offset, to allow you to offset the accounts. So I'm sharing with you the examples about the statement of cash flow for Bigger Cheese. Okay. I think this company is producing cheese, Bigger Cheese. So this is the consolidated cash flow statement for year 2017 and year 2018, So we have three categories. The first one is your operating. This is the operating activities. So this is your second category, investing. And finally, we have your financing. Okay, this is number 1, number 2, number 3. You combine all these, this will give you your net effect. 1 plus 2 plus 3, this gives you net decrease or increase in cash and cash equivalents. This is your balance BD, and this will be your balance CD. Okay, so you have three categories: cash flow from operating activities, cash flow from your investing activities, okay, and then cash flow from your financing activities. So three types of cash. You normally start with the cash inflow first. This is all the receipt. and these are all the payments. Okay, and then for the cash investing, yeah, the proceed and also the payment, the proceed and also the payment. Okay, and finally we have your borrowing, cash financing, yeah, your proceed as well as your repayment, yeah, your payment. And then when you total up, you'll get your net decrease or increase in cash. This value 453 come from your net cash inflow. I mean, total up everything, you get 58,000 plus this one 564,638 a plus 52,000. So this gives you 453. And you have your balance of cash flow, opening balance. So this will be your closing balance of cash flow. So this is how it works. Yeah, this is how it works. Okay, your closing. This is for previous year. Your closing cash will be is equal to your opening cash for next year. So you need to classify this item in the correct place. If you put the number, yeah, for example, maybe payment for intangible assets here, you put it under operating activity, wrongly classify the items, your answer will be considered as wrong. So you must know where to put the figure, whether it fall under operating, investing, or financing. Okay. This is just another example. As I mentioned, we have two methods. The first one is direct method. So in direct method, we also have three main activities, but the term here, cash from operating, from investing, and from financing. But the amount of the items here is a bit different. We have cash received from customer, how much you receive from your customer, how much you pay your supplier, how much you pay your employees, yeah, how much is the interest paid, yeah, the income tax paid. So it's more straightforward, it's direct. And then cash flow following from investing activity mean the acquisition of subsidiary, how much you pay for that, purchase for property, plant, equipment, purchase or you sell your assets, the proceed from selling the PPE. So this is more straightforward. Same goes to your financing, proceed from the share issue, from the borrowing, payment of borrowing, payment of dividend. So it's very straightforward. Yeah. However, for indirect method, you start with the profit. You start with the profit, and then you do adjustment for depreciation, adjustment for non-cash items, and this give you your cash generated from operations, yeah, cash generated from operation, and then you do adjustment for interest received, interest paid, income tax paid, and this give you net cash flow from operating activities. It's a very long process, yeah. You're working up from your profit before tax, do adjustment, several adjustment here. For example, depreciation is non-cash expense. Foreign exchange loss is also non-cash expense. And then the adjustment for loss on sale of equipment, this is also non-cash. Interest income, interest expense, increase in receivable, decrease in inventory, increase in account payable, increase in accrued liability. So all these are your current assets and your current liability So you take note all of these things, and then from there it helps you to determine what is your net cash flow from operating activity. So this is indirect method. But don't worry, I'm going to take you through the examples. Okay. However, for this income, always remember that you need to have a separate item for interest received, interest paid, and income tax paid as required by the accounting standard. You must have separate items for income tax paid, interest paid, and interest received as required by the accounting standards. And then this is for only for net cash flow from operating activities. Then you're going to combine with your investing plus your financing to give you what is your total cash and cash equivalent balance for that year. You are going to total the net cash flow from operating, from investing, financing. That will give you net decrease or increase in cash and cash equivalent plus the balance, the opening balance of your cash and equivalent. So you will get your closing balance, your closing amount of your cash and cash equivalent.